Good morning, class. Today we are going to be talking about the federal fund rate. The federal fund rate is one of the most important rates in the economy. It is the rate at which the bank lend money to each other overnight. The Federal Reserve, or the Fed, set the target range for the federal fund rate, and banks trying to keep their lending rate within this range. Federal fund rate is an important tool for the Fed to manage the economy. By changing the federal fund rate, the Fed can influence the cost of borrowing and lending. This can affect how much business invests and how much consumers spend. The federal fund rate is the interest rate that banks charge each other for overnight loans. Reserve balances are the deposits that banks hold at the Fed. Banks need to hold reserve balances to meet regulatory requirements. When a bank needs to borrow reserve balance from another bank, it does so through the federal fund market. The federal fund market is an informal market where banks lend and borrow reserves to each other. The Federal Reserve set the target range for the federal fund rate. Banks try to keep their lending rate within the range. If a bank lending rate is too high, other banks won't borrow from it. If a bank lending rate is too low, it will lose money. How is the federal fund rate determined? It's a question I would like you to answer. Pause the video to answer the question. Okay, let's look into it. The federal fund rate is determined by FOMC. The FOMC is a committee of the Fed that meets 8 times a year to discuss monetary policy and set targets for the federal fund rate. The FOMC decisions are based on a variety of economic factors, including inflation, unemployment, and economic growth. The FOMC tries to set the federal fund rate at the level that will promote price stability and maximum employment. The question I would like to ask you is, why is the federal fund rate important? Why is it important? The federal fund rate is important because it influences the cost of borrowing and lending money. When the federal fund rate is low, it is cheaper for businesses to borrow money to invest and for consumers to borrow money to spend. This can boost economic growth. When the federal fund rate is high, it is more expensive for business to borrow money to invest and for consumers to borrow money to spend. This can slow down economic growth. The federal fund rate is also important because it affects the value of dollar. When the federal fund rate is high, the dollar tends to be stronger. When the federal fund rate is low, the dollar tends to be weaker. The federal fund rate is critical tool the Fed use to manage the economy. By changing the federal fund rate, the Fed can influence the cost of borrowing and lending money, which can affect economic growth and inflation. Understanding the federal fund rate is essential for anyone interested in economics, finance, or public policy. Here are some examples of how the federal fund rate can impact our daily lives. When the federal fund rate is low, interest rate on mortgage and other loans are typically lower. This can make it easier to buy a home or start a business. When the federal fund rate is high, interest rate on credit card and other types of loan are typically higher. This can make it more expensive to borrow money and pay off debt. The federal fund rate also impacts the stock market. When the federal fund rate is low, stocks tend to perform better. When the federal fund rate is high, stocks tend to perform worse. Overall, the federal fund rate is an important interest rate that can have a significant impact on our financial well-being and the overall health of the economy. Thank you for watching this video. See you in the next video.